I think we can all agree that passive income is awesome. So investing in dividend stocks or ETFs sounds like a wonderful idea. I think we can all agree that watching a stock double in a matter of months or even weeks is super cool too. So investing in a growth stock or ETF is very exciting. But which is best? There is a case for saying that dividend investing isn't necessarily best because you're going to have to pay taxes on those dividends. Even if the dividend is getting reinvested directly back into the stock or the ETF, you're going to have to pay a tax on that if you're investing in a brokerage account. Obviously, within a Roth IRA, you don't have to worry about this. But if we're talking about investing in a taxable brokerage, this is definitely something to consider. There's also a case that investing in growth stocks or ETFs is just way too volatile and too risky, because people definitely lose the most amount of money in these for sure. For this classic question, I wanted to bring someone here on this video who invests purely in dividends and definitely lives in that world. So I called my buddy Ryne Williams so that we could discuss. If you haven't checked out his channel yet, I have it linked down below for you to go see after this video. But like I said, he purely invests in and talks about dividends on his channel, which is super cool. Today we're going to talk about dividend investing versus growth investing, and I'm going to give you a couple of my favorite growth stocks and ETFs, and Ryan's going to give you a couple of his favorite dividend stocks and ETFs, so stick around to the end for that. My channel is all about keeping investing simplified, so no matter what way you decide to invest, let's simplify this common debate of which is best. Dividend investing versus growth investing. Like I said, everyone, this is Ryne Williams. I'm sure you know him by now, but if you don't, what's up, Ryan? How are you, man?
I am living the dream, man. How about yourself?
I'm doing good. I'm doing good. It's good to see you. Looking like a stud as always.
Thank you, man.
Super excited that
black is thinning. It makes you look leaner. So
that's what it is. Oh, okay. I'll do that on the next one.
all right.
Good to see you, my friend. So like I said, we are going to be talking about growth versus dividend investing, and I couldn't think of anybody better to give us some information about the dividend side of things. So the way that we're going to do this today, I'm going to give a couple of pros about just growth investing. Then Ryan, I'm just going to ask you to give a couple of pros of dividend investing, and then I'll give a couple cons of growth investing, and then if you could give some cons of dividend investing. And then after that, we'll kind of just have a quick little discussion about which one is best or what's the best way for people to think about investing. And then a little bonus for everyone that sticks around to the end. It'd be cool if you could share your favorite dividend stock and dividend ETF. And I'll do the same by letting people know about my favorite growth stock and growth ETF. How's that sound?
Love it, man. I'm excited.
Cool. All right, well, let's jump right into it. So for me, I'm going to be going over some pros about growth investing. And whether we're investing in a growth ETF or growth stock, obviously a super exciting way to invest. The price appreciation can be exciting. It can go up like crazy. So NVIDIA is up 210% in the last year. SCHG, 40% in the last year. VGT has almost a 20% average annual appreciation over the past 10 years. And so, I mean, looking at that, you're looking at just outstanding numbers. Any one of us would be excited to see their portfolio grow by double within a year or less. Like that's insane. So obviously growth potential, which is why they're called growth ETFs or growth stocks. The next thing, and one that I really like to geek out on, is these types of companies are the types of companies that people want to work for right now. People want to work for NVIDIA. They want to work for Google. They want to work for Amazon. And so these companies are being able to take in the top talent. They're getting to pick and choose the best developers and the best web design, everything that has to do with the best talent, they get to pick. And, as a business professor, I love to just talk about how that can be a competitive advantage. The type of employee that you have, the strength of the team, that is huge. And so that's just furthering their competitive advantage for long term. So I really, really like that about these growth companies. One other thing that I really like as a pro for growth investing is that these companies do have a very low, and some have even no dividend. Now, some people would be like, well, that's not any fun. You don't get any cash flow. But what that does is it makes it so that you're just going to have price appreciation. You're not going to have a dividend, and you won't have to pay taxes on that dividend if you're investing in a brokerage account. So could be a cool strategy and way to invest. What are some pros about dividend investing?
All right, dude. So where to begin with the pros of dividend investing? The first one I would say that comes to mind is, and this is going to touch on something that people like to say against dividend investing, is that you'll hear people say dividends are not guaranteed, which is totally true. At any given point in time, a company can choose to raise their dividend, they can cut their dividend, they can initiate it, and they can take it away for good, just depending on what's going on with the company and what their policy is. With that said, even though dividends are not guaranteed, in my opinion, they're still a bit more reliable. Dividends are still more dependable, or the presence of that dividend is still more dependable than counting on the share price to move in any given direction. There's no guarantees that the share price is going to go up. It could just as easily go down. But if that dividend policy is still intact, you're going to be getting that dividend. So in my opinion, it's a bit more dependable. It's going to be more reliable than counting on any sort of share price direction. Does that make sense?
Yeah, definitely. And I agree with that.
And so that's pro number one. The second pro is, if financial freedom, for example, is the point at which your passive income exceeds your expenses, or your passive income exceeds the income then you're making from your W-2 job, then at least I think dividends in your dividend income it makes it easier to gauge your progress on the path toward financial freedom. You can say, I'm bringing in X dollars of dividend income per month or per year, and easily compare that against your expenses, or easily compare that against the income that you're bringing in from your job. And it's pretty easy from there to gauge how close you are in the progress you're making in taking steps towards financial freedom. So those are the first two pros that come to mind. And if I had to give a third, I could think of probably 100 other different ones, but if I had to throw out a third pro to dividend investing, I would say that when done correctly, it can actually lead investors to buy more high quality assets that have a consistent track record of growing their sales, growing their earnings, and growing their free cash flow, which is where the dividend is paid out from. It's paid out from a company's free cash flow. And I say that because only companies that are growing these three things, only companies that are growing their sales, increasing their net income, or increasing their earnings and free cash flow, only those type of companies can sustain dividends and grow their dividends. So as dividend investors, those are the type of companies you want to look out for. And over a long period of time, if a company's doing those things, if it's growing in those departments, not only will it be able to continue paying you out and pay you an increasing amount in dividends over the years, but also share price tends to follow earnings. So over the years, you are likely to see some share price appreciation from those type of companies as well.
That's a super good point. That's one of my favorite reasons as well to dividend investing specifically, is just the quality of asset. I like the way that you said that. And that kind of leads me well into the next piece, because I'm going to talk a little bit about the cons of growth investing, because it's not all fun and games over in the growth world, unfortunately. And we're going to start kind of with the opposite of what you said. And sometimes these companies, pretty much all the time, these companies, they're going to be that possible high reward, but that means they're going to be pretty high risk as well. And when I say high risk, it's not like a risk of, we could lose 5-10% of your portfolio if that's what you're invested in. These companies could go straight from 100 down to 0. And I've seen it. Less than 3 years ago, Lucid Motors was promising to be the next Tesla. Stock was at $55.21 per share, and today we're looking at a little over $2 per share, and the future is looking very grim. So the thing is, with a company like that, it comes out, it promises a lot, and it sounds great. It sounds like who wouldn't want to be a part of the next Tesla and get in at, a low price compared to where Tesla's at. But the problem is that if it doesn't meet certain financial benchmarks, if it doesn't meet, the things that companies need to meet in order to grow, and the pressure that it has to deal with, probably from venture capital and other things, that thing can quickly just hit the ground. And along those lines, these companies just have a very low track record. Most of these companies are newer companies, in the last 5 years or so. And kind of contrasting to what you just said about dividend investing, usually these dividend companies, they may be a little bit more boring, a little bit ones that aren't going to get the most exciting out of us. But the thing is that those companies have been around for a while. So we can see, what did they do 30 years ago, 20 years ago during this financial crisis? What did they do when, we were going through COVID? Like all of these types of things. Whereas some of these newer companies, yeah, they're promising to be great, but they don't have a track record. They don't have any data that we can really pull from. So it's really just hope at that point. And then, just like how I said that one of the pros of growth investing would be that there's no dividend or very low dividend, well, that's also a con because for most of us that have been investing for any period of time, we do like that idea of eventually having some passive income. And so, by them not having a dividend or having very low of a dividend, the only way that we're able to actually see that price increase or see our gain is by selling off shares. And at that point, you're selling your assets. And that's just something that is definitely a con, something to consider. So, what do you think are some cons about dividend investing?
So, unfortunately, dividend investing, like most other investing strategies, does have its downsides. I would say the biggest of which is probably taxes. That's the thing you'll hear most about dividend investing, is that you have to pay taxes on the dividend income that you receive, which is true. If it's in a taxable brokerage account, you're paying either the long-term capital gains tax if it's a qualified dividend, or you're paying, your normal income tax rate if it's a non-qualified dividend or an ordinary dividend, which is what you'd receive from something like a real estate investment trust or a business development company. So taxes, definitely one of the downsides to dividend investing. Now, in the same way that this is true for growth stocks, you can avoid taxes by investing in a tax advantage account like a Roth IRA. So in both departments, whether it's growth or whether it's dividends, you can avoid taxes by investing in something like that. But not every investor wants to put their money in that. A lot of people like the flexibility of a taxable brokerage account. So if you invest in something like that, you will definitely face the downside of taxes. That's one. And I would say this is one that I don't hear all too often, but I would say one downside to dividend investing, or one other downside to dividend investing, is that the pursuit of dividends can often lead investors to get a little greedy and to, chase dividend yields that are pretty juicy, pretty high, because the higher the dividend yield, the more cash flow you'll bring in. And I shouldn't say that I don't hear that often, because it actually is pretty common. I don't know why I said that, but that is another downside to dividend investing. The pursuit of those dividends can lead investors to probably put their money into assets that they should not. And typically when you get into the higher yield range, and there's some just insane yielding stocks and ETFs out there. We're talking like it's getting to the point where it's not uncommon to see yields that are 15, 20% plus, which is nice. That's really tempting. But oftentimes those are not the best assets to buy into. And oftentimes those dividend yields are not sustainable. But people see that high yield, and the trap is set. It's pretty easy to be lured in by something like that. So the pursuit of dividends can make investors chase those sort of things when maybe they definitely should not. So that's another downside to dividend investing for sure. And those are the big two. Those are the big two cons as far as I can see them. One third one that you'll hear quite a bit is dividend stocks typically will underperform, or on a total return basis, you won't generate as high of a return as other types of stocks, which is true in some cases. You can find this with growth stocks as well. But there are also some dividend paying stocks out there. I'll name a few, like Williams Sonoma, Microsoft, which is a dividend paying stock, and Watsco, which is a company, ticker symbol WSO, which is a company that is very under the radar. But there are plenty of dividend paying companies out there like those three that have actually outperformed the S&P 500 over a decent period of time. So you just have to find the diamonds in the rough. You just have to find those really high quality assets and look at the fundamentals. This is true whether it's a dividend paying company or not. But you can definitely find some good performing companies within there. But that is the third downside that I hear a lot about dividend stocks and dividend investing, which can be true in some cases, but not all the time.
Right. Yeah. I really like the one that you said about just chasing dividend yield. I've heard you talk about that on your channel a lot. I know I've said that as well. Hopefully, that's not the only reason that you're investing in this dividend stock, because yields sometimes are a facade, right? And sometimes they're a high yield just because the stock is crashing. And so the yield compared to how much the price is looks very favorable, but that's not a good stock to be buying at this point. But very well said. Thank you. So, the classic debate, I guess, that I get a lot on my channel, I'm sure you hear too, is okay, I'm investing in a brokerage account. And so wouldn't it just be smartest, or actually, I guess it could be even in a retirement account. Wouldn't it just be smartest to be investing in the stock or ETF that's going to get the highest amount of appreciation, make the most amount of money as fast as possible, and then possibly when I have enough capital to then be able to live off of the dividend of whatever that is, wouldn't that just be the time to then move anything over from like your growth stocks or growth ETFs, move that over to dividends and then just live off that forever? Like why should we invest in the dividend stock or the dividend ETF as we're growing our portfolio? Why not just move everything over if the growth stock or the growth ETF is going to get you there faster? So I know I hear that a lot. I have a couple ideas, but what have you thought of, or why is it that you do choose to invest in dividend paying stocks and ETFs rather than growth primarily?
So that's a really great question. That's a really great point. And I apologize in advance if this gets long-winded because it can be kind of a long answer. So let's say, actually, let me just make it very short because I really can make this a long tangent. So from what I've seen, and you guys out there watching, you can crunch the numbers. If you go to the marketbeat.com dividend calculator, you can play with it, plug in some numbers and see how it turns out. But from what I've seen, when you cut out the middleman, when you just, if someday your goal is to live off the dividend income, in terms of portfolio values, if you take option A, which is kind of what you're proposing, growth stocks, then dividend stocks, versus option B, which is just dividend stocks all the way through. Let's say it's just schd 100%, right? By the time you reach financial freedom, just with dividend stocks, because of the snowball effect from the dividend growth, from reinvesting the dividends over those years, you should end up with a higher amount of income and a higher yield on cost for that portfolio value. Let's say it's $1 million. $1 million just dividend stocks all the way through. Your annual dividend income should be higher than if you were to just go grow stocks, then sell out of those, put it into schd, for example. If you had $1 million in growth stocks, no dividends, sold out of them today, invested that into schd, which I think has like a 3.4% yield, today, you'd be generating $34,000 of annual dividend income per year because that's the starting yield of schd. 3.4% of $1 million is $34,000 per year. You would have a much higher annual dividend income if you were just investing in schd all the way through.
Yeah.
Does that make sense?
And that does make sense, only because I think one of the things there that's hard to articulate or hard to be able to explain too much is that idea of dividend growth. And so schd or whatever we're talking about here, you're buying in at a dividend at a certain point, and the price is at a certain point. As that price goes up and the dividend goes up, so much so does your dividends that you originally invested in. So you might be investing in something where you're getting a $1 dividend, but 5 years down the road, it's grown so much, now it's a $2 dividend. And so that's what you're saying. You're saying that, along the way, this thing has grown. And instead of just taking the starting dividend yield from your fully price appreciated asset.
Yeah, you did a way better job of explaining that. Like I said, I'm just full of gibberish over here.
No, you had the idea, and that is where my mind was going to as well. And so one of the ways that I like to answer that question as well is, okay, first of all, the way it's phrased is assuming some things, right? Because people are saying, well, isn't it just best to put all your money in the growth ETFs and growth stocks, and then when it goes up a crazy amount, then take that money and put it into dividends? Well, that's not a bad way to invest. And if your money did go up like crazy and go up, 500% or something, that's amazing, but it's not guaranteed. we're basically, or whoever's saying that is basically saying, well, if I just had money in Nvidia 5 years ago, I would have made, $10,000 off of my $100 or whatever it may be. And yes, that's amazing, and hopefully that happens to everyone out there, but that's not necessarily going to be the case. And so at the end of the day, you do have to understand, and which is why I wanted to do this format showing there are pros and cons, because I think that we like to just kind of take in the pros and we hope for the pros and we forget about those cons. And so, yeah, growth investing can be very exciting, but it's volatile, which means it can be volatile going up, but also volatile coming down. And so you have to be careful with that. Whereas dividend investing, I think, is just a little bit more sustainable, a little bit more even keeled, and you kind of know what you're getting. It's just not as fun. That's what I've seen, at least.
Yeah, that's kind of the trade-off as far as I can see it. Like, let's say your goal is to get $1 million portfolio value. You might get there quicker with a growth-oriented approach, maybe, depending on what's going on in the market. It might take you less years to reach that point. But on the other hand, with dividend investing, even though it might potentially, who knows, depending on what's happening in the market, it might take you longer to hit that $1 million portfolio value. But by the time you do, your annual dividend income will be much larger than if you were to take the growth-oriented approach, then reinvest it into dividend stocks. So it's just a trade-off.
Right.
And to close the book on that, like, one thing I always say is there's more than one way to skin the cat. People don't like when I say that, but it's just a phrase.
Yeah, no, I get that. And I do totally agree with that. I think one last thing that I wanted to just throw out there too is a lot of people will say that they don't like to invest in dividends specifically because they don't want to be taxed. They don't want the tax drag on the way up. And that totally makes sense. You do need to keep in mind that if you're going to do this strategy, let's say you're in a taxable brokerage account, yes, you're not going to be taxed on something that doesn't have a dividend on the way up. Let's say you have a growth stock that has no dividend all the way, you get to $1 million, great. At the time, though, that you're going to take that growth stock or growth ETF and move it to a dividend asset, you're going to be selling those shares. When you sell those shares, you're going to have a massive tax hit. Massive, because at that point, let's say you did invest, $100,000 and it turned into $500,000. You're now going to be taxed on $400,000 of that capital gains, right? So I think people just put this in their mind that, well, with dividends you get taxed, so I'm going to go growth. It's not you get taxed on one end. It's you're going to get taxed either as you grow or you're going to get taxed at the time that you've grown and you have all of that money. So you just have to keep that in mind. It's not either or. Very good. So, at the end of the day, how should people invest? What do you think?
Gosh, man, you're really putting me through the ring of fire with these questions. It's kind of like working out. It's kind of like you asked me, what's the best type of cardio? The best type of cardio or the best type of workout is the one that you can adhere to. The best type of diet is the one you can adhere to. And I think the same is true when it comes to investing. The best investment strategy is the one that's going to help you stick to it. And it also is the one that makes the most sense for your goals, how you want to utilize your investments when you do finally enter retirement, whether you want to sell off shares, whether you want passive income. Those type of things have to play a role in what type of investment strategy you decide to use. And when in doubt, you can, also just have a balance between everything. There's nothing wrong with having some growth stocks, having some dividend stocks, or ETFs. There's nothing wrong with getting the best of both worlds at all. So I think when in doubt, that's probably the best way to go.
Yeah, that sounds like a little known 3 ETF portfolio that somebody sometimes talks about. I don't know who, it may or may not be me, but yes, I love that, dude. I love that. I couldn't have said that better, so I'm not going to. Let's give the people what they want. I'm going to go ahead and give my favorite growth stock right now and my favorite growth ETF. And if you could give your favorite dividend stock, dividend ETF, and we'll wrap it up. So for me, not really a surprise. Any of you that follow me, I've talked about both of these things recently, and I talk about them often. My favorite just growth stock right now is by far Microsoft, by far. I absolutely love the position that they're in, the competitive advantage they have. I love all the things they're doing with AI. I love how far ahead they are in all of that race. But what I love even more than that is the way they run their company. Their balance sheet is immaculate. The way that they preserve cash flow, the way that they have such equity, such high assets. It's just insane. And then the last thing that I just really like about them specifically is their stickiness with their customers. There's customers that just will never leave, the anything with Microsoft. They're not going to one day just not use Microsoft Word. So for me, Microsoft by far, especially with what they're going to be doing in the future, but also just what they've done in the past. And then my favorite growth ETF is honestly at this point is QQQM, but I really, really like SCHG and VUG. So QQQM is Invesco's, SCHG is Schwab, and then VUG is Vanguard. So all three of those, though, they're all just a very broad growth ETF. Think about like the S&P 500, but just growth. And the reason why I like those over some of the more exciting ones like SMH or VGT is because those ones are sector ETFs. They're going to be exciting, especially in semiconductors, or exciting, especially in technology. But if any one of those sectors are to die out, that's going to be a bad day for your portfolio. So I like to keep it broad. I like to keep it simple. So that's those are my favorites there. How about you?
So for dividend stocks, we're talking about individual companies. At least for right now, I can't think of a more perfect company than Visa. And you might hear that and think, Visa's not a dividend stock. What are you talking about? But Visa is a dividend paying stock. And I consider that to be in the dividend stock family. That's what I go for. I go for stocks that pay a dividend paying stocks. Visa is one of them. They have a low starting yield of about 0.75%, 0.75%. But they are a dividend growth behemoth. They are growing their dividend and increasing those payments. At least for the last 5 years, every year on average, they've grown their dividend by over 16%, wow, which is unreal. You're getting a 16% plus pay raise just for being a shareholder of Visa. And when you look at the company, I just think it's like the gold standard of like financial statements. Their income statement, just growth from top to bottom, really solid and aggressive revenue growth, profit growth, earnings growth, all that jazz. And not only that, I don't know that I've ever seen a company as profitable as Visa. I think their gross profit margins are above 90%, maybe 97%. Their net income margin, which is the bottom line, that's over 50%. That's unheard of. Okay, they have very little net debt. Their free cash flow is just growing like a weed. In other words, this company is just a money printing machine. And I think the situation for Visa is only going to continue to get better and better as time goes on. They're already the world's largest payment network, bigger than others like MasterCard and American Express. Those would be the second and third place. And as people use cash less, that's kind of the trend. People are using cash less, using their cards and digital transactions more and more. Visa only stands to benefit from that. So I think the future is pretty bright for this company. And if I had to pick one company, like if I had to liquidate my entire portfolio and just put it into one company, which I don't recommend anyone doing, but if you had to, Visa, in my opinion, is where I would go. So that's the individual stock. Looking at ETFs, it's going to be no surprise, Nolan. You already know what I'm going to say. Starts with an S, it ends with a D. We're talking SCHD, the holy grail of dividend ETFs. And people are probably pretty sick of hearing about this ETF, but there's a good reason why it's talked about so much. Just this one fund, you're getting over 100 different dividend paying stocks. Okay, and each one has, to be in the fund, to be in SCHD, you have to have been paying dividends for at least 10 consecutive years. So each company in there has a pretty solid track record of paying their dividends. That's what you want to see. And if we just talk about the dividend stats, you're getting a really nice 3.4% starting dividend yield. For some investors, you may hear that and think that's pretty low. That's actually a pretty respectable dividend yield. But along with that, you're getting a really nice, kind of like with Visa, you're getting a really nice double-digit dividend growth rate. I think on average every year for the last 5 years, it's maybe somewhere between 11 and 12%. So not only are you getting 100 different respectable dividend paying companies, but you're getting a nice starting yield that's going to be increasing the payouts at a pretty aggressive clip year over year. And I just don't know that you can lose with SCHD, but there's some other really solid dividend paying ETFs or dividend ETFs out there, like VYM, which is pretty similar to SCHD. It's basically Vanguard's version. You have VIG, another Vanguard fund. It's the Vanguard Dividend Appreciation ETF or something like that. And then you've got one more, DGRO, which I think is a wisdom tree fund. That's also a really solid dividend ETF. But those are the handful of ones that I would pick. SCHD right there at the top is the holy grail. And then Visa for the individual company. So
couldn't agree more with anything you just said. Happy to have you on this conversation. Thanks a lot, my friend.
Man, thank you for having me. Anytime. Love it.
All right, brother. I'll catch you on the next one.